Private equity isn't just about money. It's about people, principles, and making the right calls under pressure. In this episode, I sit down with Brandon Wolfe, co-founder and partner of Jordan Partners, to explore how trust, integrity, and strategy shape high-stakes investments. We dive into what makes really great partnerships, how automation is changing the game, and the emotional roller coaster of building and letting go of businesses. Whether you're a founder, investor, or just curious about what happens behind the deals, this conversation will shift how you think about growth, capital, and the power of choosing wisely. How is private equity doing in today's climate where a lot of companies don't really need investors anymore?
So there are millions of types of private equity, really. So you can do anything from venture to leverage buyouts and everything in the middle. And what's kind of in the middle is a little bit more like growth. I think what you'd find is not all companies need an investment partner, but some still will. Within venture, there was a big bubble only a few years ago, and we're still working through that. So whether you are a fund that had capital then or is just raising right now, everyone is still kind of working through that in the venture world. On the other end of the spectrum, you've got leverage buyout folks who require debt to buy a business. As we all saw with mortgages or anything else, money is not free like it was a few years ago. So you've got folks similar to venture, but a different kind of profile of company that are working through the portfolio they already have, figuring out how to make sense in the new normal, things like that. For us, we've always focused on bootstrap businesses that are unlevered and have never taken in institutional capital. So what's really fun about working with teams like that are that it's basically a blank slate for everybody. You can kind of build the strategy and the capital allocation plan for what's right for that company. So in general, we can talk high level about what private equity broadly is doing, but it's just such a vast market that you just have to find individual operators, high integrity leaders, companies, and that's the magic.
So it's like taking a business that doesn't need you and then throwing a bunch of cash on it to grow it really fast, doing something it's already good at.
In general, what you're mostly providing is some expertise and giving people the ability to do things that they might not want to do if they had to risk it all themselves. So case in point, oftentimes when the first institutional capital comes in, you might see a little bit of secondary for the founders of the business. What people have found is that selling even a small stake in your business sometimes allows you to sleep at night so that you don't have to worry about losing it all. And that often causes people to take swings they wouldn't have taken just on their own. But I think the biggest part is if you have an investment partner who you trust and someone who sees the world and the future the way that you see it, you actually then have a person who sees companies all day, every day, who has capital markets relationships all day, every day. And that's really kind of where it comes in. The operator and the investor have this sort of yin and yang type moment together. That's the ideal.
What do you look for in a business to say, yes, let's work with you?
It really starts with people. It absolutely starts with people. I've seen this time and time again. Things go sideways. Sometimes things even go down. The number one thing that doesn't change is the quality and the integrity of that person. So we have this profile of a high integrity leader. There's a handful of actual variables we look at. We can dig into that if you like. But the number one thing I'm looking for is someone at the helm who I can trust, who I can work with, who will actually take our advice, whether we're in a majority or minority position. And then after that, we really focus on software and tech enabled services. And our typical business is going to be 10 plus million revenue, growing 20% plus, break even or profitable. What's nice about those numbers are 20% growth is a really nice number, but it won't be like the rocket ship example that you used a second ago. It's the kind of thing that you can sort of sustainably, durably build over the long haul. The reason we really value break even or profitable businesses are that they've proven that they have the ability to actually, sell a dollar for more than just a dollar out in the market. And at the end of the day, we're really trying to find software and tech-enabled services run by the best possible leaders we can, where we can hopefully make them better as a partner.
Okay. Why is it that 10 million is that number that gets you guys excited?
So 10 million is a rough number that you've clearly proven there's something here. There's not only product market fit like a venture capitalist thinks about, but there's also real scale. Separately, at 10 million, the problems that you face start to be really problems of capital allocation. And that's where we can help the most. Kind of from 0 to 10 million, you're getting your first customers, you're figuring out what the flywheel is. There are investors who are fantastic at that. Where we're especially helpful is helping you think about how to make your financials stronger, potentially acquiring smaller businesses. That's actually one of the number one reasons to work with us and things of that factor. So it's just what we're good at, it's what we love, and it's also where we think we can add the most value.
And so you're putting money into these businesses. What kind of a stake are you usually looking to get?
Most investments would be majority, but in some cases, you can do a really significant minority for the right people.
Why go for a majority and in some cases accept less than a majority?
Yeah. So the benefit of majority is control, and it allows you to really run the playbook that you think makes the most sense. Now, you obviously have to have the team operating it, and there's still true partnership there. In some cases, people aren't ready to have a majority owner. They are ready for a 25, 40% owner who has a real say around capital allocation and other things that matter. But in some cases, people are just ready for a significant minority owner. So when you think about that, back to your question earlier, the real bottleneck for any strategy in investing is just high quality people. I'm a big believer that when you find someone who's got something special and they're doing something special and you diligence them from all possible angles to realize that they are exactly the kind of person you want to partner with, that's the kind of person that, even if it turns out to be a significant minority, you absolutely have to think.
If someone allows you to acquire a majority stake in their business and they go along with your recommendations, because obviously at this point they don't have the ability to stop you, and you tank the business, like they're the ones that get screwed. I mean, you both get screwed, but it hurts them a lot more. So what happens?
If you're going to bring an investment partner, you really need to underwrite that person as a person, not as a brand name or a splashy story. You need to underwrite that person. Do they have a history of bankrupting businesses because of a lot of debt or poor choices or short-term thinking? There's plenty of people who have that track record if you actually go explore it. Number one, I would say when people are usually selling majority control, you'd often find the founder is probably exiting the business and someone who might have been number two at the firm is stepping into the CEO role, or someone we've identified outside the firm is stepping in as the CEO role. But it's still a very valid point, because if you're the founder, you might cash out all of your stake, but you also might very well have rolled some of your stake. And so you're asking the perfect question of, when I have continued ownership in this business, who are the people that are going to be making the decisions for it? Do I trust them? Do I think that they're good stewards of my capital? That's exactly how a founder should be thinking when you sell control.
So what happens in the case that maybe not your firm, but another firm, let's say they destroy the business by making bad decisions? Like, what happens?
I mean, every situation is going to be different. And so this is me like literally describing like all the ills of my industry. So this is not something we have a track record of doing. Let me give an example. And this is actually probably, I think, really illustrative for folks who are thinking about this. I have a friend who is also an advisor for our firm. She is a fantastic entrepreneur, built a business, bootstrapped it, real scale, incredible. Ran a process to sell majority control she was just burned out, right? That's another reason you'll often find people do it. Like you scale it, you build it, and you don't have enough gas in the tank, but you also realize it's still got a long runway. She went with the highest offer, even though the person she liked the most was only 5 or 10% less than the highest offer. Ultimately, the highest offer ran into a ditch. So what did that look like? It looked like her remaining stake not being worth what it could have been. It meant a lot of agita and stress about watching the thing you created be run by the highest offer, but not necessarily the best owner. And fundamentally, it's like all the stages of grief. You just watch this slow moving train wreck in front of your eyes, and at the end of it, you just have to make amends with it. Now, the flip side of it is she sold her business well. She's still going to do just fine. She's a wonderful person. But it's a good example of the highest offer is not necessarily the best owner. The person you trust the most, the person you like the most, the person who references the best, that's probably the best owner.
Is there no way to sue them to regain control, even if you don't own all the equity, to maintain or regain some sort of control over the decision making, to stop them from destroying the company?
So, not an attorney. I'm going to put a big disclaimer right there. What I would say in general is, I don't usually think there's a recourse like that, because at the end of the day, you made a transaction. The transaction was exactly, like, short of fraud or anything like that, there's not a lot of lawsuits that happen in the US for things like this, to my knowledge. And that's ultimately a good thing, because it encourages us to take risks. I mean, you're in Europe right now. Europe has a very different risk-taking culture based on liability and things like that. We have much more of a entrepreneurial culture that it says you make a bargain, you get the benefit of the bargain, you don't get to come back and, decide that you just want it back for free. Now, you've seen people sometimes try to buy back their stake in the business, but it just gets really messy.
So what are the hardest things that you see people face going through this kind of a transition?
The hardest thing is letting go. And I've seen this from friends and folks we've backed who even sold their business successfully. You spend years and years and years building this thing, living, breathing it. And then there comes a day where it's someone else's. And there comes a day where your daily routine is very, very different. And what I've noticed is that sometimes people almost just want to like go start the new thing all over again. And of course, they're at a different stage in their life. They're 10, 20, 30 years down the road. The market they knew so well 10, 20, 30 years ago has changed. And so I've seen a couple of different reactions people have had to this. One friend who I thought was going to jump right back into the deep end got really comfortable being like, you know what? I'm semi-retired. You know what? I'm actually retired. And so, but that was still a process that took about like a year to watch unfold. There are other folks, they just kind of busy themselves with projects, and whether it's a software project they're developing themselves or something else, they just go right back into it. Now whether it reaches the scale of what they did previously is TBD. By far the hardest part is just letting go of this thing you created, because at the end of the day, as much as a business is a business, it's also a creation of the entrepreneur.
Have you ever started a business and tried to grow it?
That's exactly what my private equity firm is. Anything that any entrepreneur has experienced, we've experienced it, and if we haven't experienced it, it's coming down the road.
So what was your experience?
I would say in general, you have to get your first coalition of people who believe in you, whether it's your partners who back you, which is what we've done, or the vendors or companies who want to work with you. And it's like all things, you really just have to show people your vision. You have to tell them your dream and where you're going to take the business ultimately. So for us, with Jordan Partners, we always say that we intend to have one of the best reputations in private equity based on performance, culture, and trust. And if you underwrite every one of our decisions based on how it impacts performance, based on how it impacts a special kind of culture, which our industry is not always particularly good at, and how it impacts trust, that's the vision we have. And we are really early days in that. But even 20 years from now, we're still going to be really early days in that. So fundamentally, just like any entrepreneur, we have to go out and get the coalition of like-minded people to execute the mission. And so fundamentally, you have to be absolutely passionate about that mission. Otherwise, you just give up. And the only answer that I've seen for entrepreneurship, for folks I've studied, for myself, for friends, you just keep going. If it makes sense, you just keep going.
How do you separate yourself honestly from other people? How do you honestly build that coalition in a way that doesn't feel cookie cutter to everyone you're talking to?
Sure. Well, I would say one thing that's interesting about this business, not a lot of folks actually lean into performance. Like, we are obsessed with being one of the best performing funds of the future generation. But what is uniquely us? I'm originally from a small town in Virginia. It's called Covington, Virginia, on the West Virginia border. The main industry is a paper mill. There's a main street that supports the paper mill. I grew up knowing nothing about investing, but discovered it just out of pure love and passion. Really, after the financial crisis, that was the first time I ever learned about what investment bank was, or Warren Buffett, or anyone. So what does that mean? When I go to meet a company, and most of the companies we back are in places like Nashville or suburban Philadelphia, not necessarily New York or the Bay Area, nothing against them. It's just, there's a lot of those venture capitalists and everything else you described are already there. When we go to these places, we're culturally aligned with the folks we're trying to back. And so the identity that we've built that represents who we are is Wall Street talent, Main Street roots. So how do we try to stand out? Not only are we going to give people anything that they could get from a competitive firm in Greenwich, Connecticut, or anywhere else, we're going to give them the Main Street roots that I grew up with and my co-founder Gordon grew up with in a similarly small town. I think that the way you cut through the noise is you show up with humility, you show up with some expertise and some insights, and you just give people a much better experience, because at the end of the day, this is all about one-to-one partnership.
So when you convince you have like a board of directors, so like how do you handle the actual process of acquiring the equity and all of that?
For us, it's pretty straightforward, since the co-founders are the deciders and we're also the ones who are really working with the companies directly. In most places, it's exactly what we described. There's a board, which is usually called an investment committee, and that investment committee would take all the layers of folks on the team who've done the work, sit around a table, figure it out. But in our case, my co-founder Gordon and I are the ones meeting the entrepreneurs, getting to know them, underwriting their business. We do have a checklist. We do have 7 things we're looking for specifically every time we meet a company. And we have a really extensive checklist that is meant to just kind of put speed bumps in your decision making. Because the number one thing about investing is you don't want to fall in love with ideas. It's one of the reasons I think sometimes like true entrepreneurs, operators, are not always good investors, because the secret to operating and being an entrepreneur is you just run at the problem. The secret to investing is sometimes you take a step back and be like, hold on, let me actually think about this, because it sounds good, but that might not be the way it plays out. So in our case, anytime someone's talking to us, they're dealing with the deciders. And that being said, the deciders still do everything we can to like slow down the process and make a really thoughtful decision. starting with our checklist.
It's funny you said that. Decider reminds me of President Bush.
Yeah.
I'm the decider. I know, it was like 20 something years ago. It's like 20. It's like 23ish years ago. So
It was more his tone and delivery. That was more the problem, you know.
Yeah. So you come up with this process. They're talking to the decision makers, and then once you decide to go through with the transaction and it goes through, are you specifically working with them, or do you have someone that you put in place to manage that company, something like this?
So we're specifically working with them ourselves. We're also bringing to bear a network of advisors. And so the network of advisors are folks who have had really great careers in the C-suite of software firms. They sit on the boards with us. Some of them might actually go operate at the company, or they're helping us find the best go-to-market people, the best C-suite that we can find to actually put into the company. And we are directly involved with every single company. And where we're really focused is kind of three things: being the organizer for a C-suite of advisors to make a big impact. Then we're separately very, very focused on capital allocation. Most businesses we buy or invest in are looking to aggregate smaller players around them. And so that's where we are hugely influential in terms of finding the targets, helping them think about the targets, similar to what we just said about how we make our own decisions, passing on targets, because deal fever is the worst possible thing you can have if you're looking to aggregate your competitors. And then lastly, as technology investors at heart, we really lean into technology investments. What I've noticed in private equity and some other places is sometimes to boost margins or make the business look really profitable in the short term, people will make these sort of like naive short-term decisions, when in reality, everybody should be investing in automation to some extent. Everybody should be thinking about artificial intelligence deeply. And to the extent that we can actually automate and grow revenue, or at least improve margins off those automation investments, that's something we're going to lean into with everybody. Very, very much hands-on, while also understanding that the business can't fulfill our mission without the great operators at the helm.
Once you've acquired the equity for this business, what are the steps that you take specifically? Do you have a process? Like you said, you have 7 things that you look for during your diligence process. Is there a checklist of things that you do after you actually acquire them of what you do, or is every business different in that regard?
So a lot of private equity firms like to say they have a playbook, and playbooks can be quite prescriptive, and sometimes it actually can maybe upset the apple cart, so to speak. We do a few things with almost every business, but it has to be tailored to what that company's situation is. And so what we do coming in is we immediately start looking for assets that we could be acquiring around them. We've got 2 investments right now. One, the M&A strategy just hasn't yielded anything of interest, but the business has been growing so fast that it hasn't. In the second business, we found an incredible number of things to buy straight out of the gate. So that's one thing we do. The second thing, we're always looking for businesses that are already investing in automation. If you've got your head in the sand and you're not thinking about automation in 2025, we're probably not the right partner for you, and you're definitely not the right partner for us. So in the case of both businesses we've backed, we've just really encouraged them to lean into what they're already doing and to try to surface new ideas for them. The number one thing there you want is a partner who's not going to tell you to take your foot off the gas when you've got a good thing working, just because it helps profitability in the short term. The last thing, I mean this respectfully, operating is really, really difficult, but operators are not always great at capital allocation. So in some companies, we've come in and encouraged them to unwind a business line they were in because it just wasn't producing the return on capital they thought it would. Operators love to think about revenue. They're like, oh, I should do this thing because it's going to get me X 100,000 or X million in revenue. But if it's just empty calorie revenue, you sort of have to get them to unwind it. So that's really fundamentally what we do.
What do you mean by empty calorie revenue?
There's a lot of the times that you'll get a big contract, but the big contract is eaten up by all the costs that are required to serve that big customer. Sort of the quintessential example is sometimes naively people want to serve a Walmart or a similar giant like that, but they will find a way for them to get all of the value out of that contract as opposed to something that's much more repeatable and much more profitable for the firm. The other thing we like to do with every company is to have them actually look at their unit economics per customer. So what I've found from bootstrap businesses like we target on, for instance, is they'll be like, well, my revenue is X and my profit is a fraction of X. I'm good. But if you actually look in the middle there, sometimes you'll find, similar to the story we just had about, empty calories, there are some customers that are losing money on. And you have this moment where you're like, how did you not know you were losing money on this customer? They're like, well, but my revenue is X and my profit is a little bit less than X. And you're like, no, but profit can go up if you actually fix that contract right there. So that's a big part of what we do every time we come in.
Do you have a set group of contractors you work with? Like for automations, for example, if the team doesn't know how to do it, you go, okay, well, we've got this team and they'll come in and they'll automate this thing. Or, okay, we've got a CFO and they'll come in and they'll go through all of your books and cut your costs. And like, do you have like this kind of a, like, team like external partners that you bring in for different things? You go up.
You're exactly right, and we do in all those cases. What we like about the finance function is that it's generalizable across companies. So you can have a quality of earnings firm or a finance firm that you can always bring to bear. The contractor on the software development front is a little bit trickier because at the end of the day, not all businesses need to have something. They don't all need to reinvent the wheel, basically. So I think the first step for a lot of companies is just having best in class off the shelf software and technology in general. And then you can decide if you need to build anything customized for yourself in house. But there are a handful of dev shops that we really like, we really trust, and we would work with when appropriate.
And so they also handle automations and AI integrations and this kind of stuff.
Yeah, when necessary.
Okay. That's good to know. I was going to say, because I invested in an agency that does that stuff. So, but they're like starting up. I is a good friend of mine, and I invested when he had the idea. So I've learned as an angel investor, like you've probably learned from private equity, right? You go, okay, at 10 million, it's something safe. I thought I can have more value that I can provide to them when they're at the idea stage, but then the chance of success is much lower. And so my cash gets me a lot more equity, but I'm taking on a massive risk because I'm usually putting in the money that they need to get started. And so I've taken a step back as an angel investor because I don't really want to keep losing cash because the people I'm investing in, a lot of them are first-time founders. And so, but he had experience working with me as my COO for my last tech company. So he's really good at what he does. And so I'm trying to help him to get access to more leads and all that. Actually, one of the other guests I was talking to is going to probably work with him. So that's why I was curious to know about what you're doing, because you were saying automations and all that.
Yeah, I'm happy to get to know him. And to your point about angel investing, I always say there's 1,000 ways to build a business, which means there's 1,000 ways to invest. And what you just kind of described about the risk reward continuum, whether it's angel or later stage or anything else, everyone's just got to find the spot where they're comfortable and lean into that.
Yeah. I think if I go back into investing, it would be at a point where the company already has money and they want to grow it. Right. But then I would have to put in more money and I'd have to get less equity, which I think is okay. Because like I've wanted to for a long time develop a passive income portfolio of just cash flow businesses that I don't have to run. But generally, the only way to get enough of a return is to get in super early when they need your cash.
For an individual investor like yourself, the percentage ownership isn't really that important. What matters is the share price increasing in value. Are the people the kind of folks that will take care of minority investors, or will they steamroll them or railroad them?
Usually my goal has been to be the only investor where like you don't need more than what I'm giving you to be profitable. And therefore, if you take a dividend, I take a dividend.
What sort of percentage ownership are you usually winding up at?
20 to 30.
Okay. Yeah. It's reasonable.
For like 25 to 50K.
Yeah.
But it's failed almost every time.
When you're writing checks of that size and the company's that early, they almost always fail. And I don't mean that negatively. It's just kind of how capitalism works. But when they work, as long as they really, really, really work, it can still be an okay portfolio.
The business ideas have always been good. It's just that if they're a first-time founder, I've already learned the lessons that they've yet to learn. And the only way that they're going to learn those lessons is not by listening to me tell them you're going to have this happen, watch out for it, is for them to experience it, even though I want to be there to advise them.
Right.
It's like teaching a kid. I don't know if you have any kids. I think we talked about this. I used to be a teacher of young children when I was in China. So I have experience. I don't have my own kids yet. But what I've found is when you tell them something or you teach them something explicitly, they generally always ignore you. Or if you say, don't do that, don't jump off that table, you're going to get hurt. And they go, well, I need to jump off the table to see if I'm going to get hurt. Right? So like, well, he said it, but I don't know. I need to see it for myself. And so I feel like first-time founders are like that oftentimes, where you go, look, be careful. You're about to come to a really precarious position and you need to be aware of this. And like, it'll be fine. And then it happens and they're like, well, Well, I guess you were right.
So it's funny. I mean, touches on so many threads. I mean, I've got 2 kids. One of them is an adult now, and I've seen this play out. I taught middle school math and Teach for America straight out of undergrad. Same dynamic. My joke about teaching school was that I couldn't hire, fire, or pay them. And so that was sort of like, that was a really difficult management experience. What you're describing is exactly right. And this is why, back to the start of the conversation, like, it's all about the people. And when we're underwriting people for what we call that high integrity leader profile, there's really 2 things we're especially looking for, which is a relentless learner and someone who has metrics in place to change their mind right away. So one thing that could maybe help your screening mechanism, there are some folks who just don't do first time founders. They do serial founders, which is fine, but that's obviously a much narrower universe, because sometimes when people are really successful, they just run the thing forever. But what I've often found can be really helpful is to look for someone who's a relentless learner, whether they read voraciously, they pick up new hobbies, travel the world. What are they doing to show that they're never really content, that they know everything? But then they also have metrics in place to change their mind right away. If you walk into an office and somebody's got an LCD screen up with like all the metrics and things like that, or they're just on top of their numbers cold, that's really what you're looking for. This is why I'm not a venture capitalist. I don't know if anybody can ever kind of spot Jeff Bezos before he becomes Jeff Bezos, or Bill Gates before he becomes Bill Gates. Plus, there's always like an element of luck. But I think in both those cases, first time founder or not, they are voraciously curious and very much on top of their numbers. So that's one thing that could help. Or you could just give up angel investing if you prefer.
I don't care if they go public or get acquired. I'd be happy with someone that runs this business for 20 or 30 years and generates a dividend for me every quarter.
Yeah.
Or every month, just a little share. Even if I'm getting only $500 a month, like that's $500 a month I wouldn't be getting otherwise. Like that's what I mean by a passive portfolio. I would love to have a passive portfolio income of 10, 20, 30, 40K a month, 50K a month, even 100K a month, right? Amazing. Because you know that money is coming month after month, and you can steadily plan for that, and you can take care of people. You can do what you need to do to have a life where you don't have to feel so much stress. Otherwise, you have to run a business to generate that revenue.
Right.
So if I had to choose between running my own business that generates that revenue or investing in other people that generate that revenue for me, I'd rather invest in other people that generate that revenue for me. I tried that over the last 7 years and it hasn't really worked out. So I'm running my own business to do it for myself.
Yeah. Well, it's interesting. I mean, there's so many different types of investing that there's almost nothing that is that guaranteed 10, 20, 30, 40 a month. You know what I mean? If you find that thing, it will just get priced to the point where you overpay for it on the way in, most likely. Now, you can invest in other people. I mean, that's very much what we do. Number one thing to do is just kind of pick the risks that you're comfortable with or not. And, the risks of something going to zero are higher when you're early stage, like no doubt about that. The risks of going to zero are higher when you're involved with questionable people. Obviously, no one gets involved with bad people, but I've watched folks all the time be like, well, he's not really a nice person, but I'm sure he'll make me money. Like that's a good way to kind of wind up like heartbroken almost. Or even worse, like I'll see professional investors back somebody, and all you have to do is Google the person and go to like page 3 of their Google reviews to see that they have like an FTC order against them from scamming people previously. This is the level of diligence that is not always brought to bear on people by investors. So, and that's among the institutional professional crowd.
What's the most important thing you've learned so far in your life?
In professional, and I'll get to personal because personal is a lot more important. We're not all just like investing in robots, right? In the professional world, it's really, one, I would emphasize what I've said, that it's all about the people. It's all about the people. If I give a second one, it would be, there's really only a couple of variables that really matter. Everything else is just kind of noise. And to the extent you can look at any investment, whether it's an early stage passive income or something later, to the extent you can just isolate it to the handful of variables that matter the most and ask yourself how well you can understand them, what do you think is going to happen with it, that's really where the best investments come from. Now, of course, you can fill out a really complicated financial model, a really long memo. You can do hours and hours and hours of diligence calls, but you have to get those core variables right. Otherwise, you're just banking on luck. I think in my personal life, the number one thing I've learned is you just keep going as long as what you're doing makes sense. I had a daughter when I was a sophomore in college. Both my parents passed away around the age of 60, which certainly hangs around the back of my head. As a 40-year-old, I've been divorced. Like I've experienced things in this world. The way that I view life and success is pick a direction and you just keep your shoulders going in that direction. And if it's the wrong direction, then you need to pivot and you need to go elsewhere. But as long as you're marching in the right direction, the only thing you can do is like keep your shoulders square at it and just keep going. That's what I've seen time and time again, not just for myself, but for people through history.